Okay, everybody, welcome to our 4-4 lecture today, which is our last section in Chapter 4. We're going to be doing our end of period work for our departmentalized business that is in merchandising. So, this should be a pretty nice review for us, nothing too new or strenuous. Remember that at the end of a fiscal period, we need to prepare all of our temporary accounts for the next fiscal period. So we do our closing entries where we close out all of our temporary accounts. Our permanent accounts are left. We have 4 closing entries that has not changed. It's just going to be that some of those entries will have quite a few accounts in them. So our first one, remember, is our closing entry for our income statement accounts that have credit balances. So that is typically our sales, and then we have some of our contra cost accounts that are in there as well. When we do this one, remember that they have credit balances, so we need to debit them in order to close them. Our second closing entry is for our income statement accounts that do have debit balances. This is the largest one. It's all of our cost accounts, revenue, contra revenue, and then all of the expense accounts, which gets to be quite a few. And then our third closing entry is to record either net income or net loss, and that of course goes into our retained earnings. And then we have our closing entry for dividends. So those have not changed. It's just that some of the accounts that we close might be new to us. So let's take a little look here. The one different thing is that normally we've only ever had one income summary account, and we've only ever used it at the end of the fiscal period. But as you know, we have had income summary accounts for our different departments. So that means that in order to do our closing entries, we actually have to have an income summary that's just general. So that's our only new account, but it acts the same way as any other income summary account. It could have either a normal debit balance or a normal credit balance, depending on whether we have a net income or a net loss. So all we're going to do is take a quick look at our closing entries. This, of course, is the one that closes our income statement accounts that have credit balances. So remember, Income Summary Grills actually has a credit balance, but in order to close it, we have to debit it. Same thing for our sales and our purchase returns and allowances for both grills and furniture. Those are those contra cost accounts we were talking about. Cost accounts are we normally classify as purchases. So the contra ones would be like when we return grills or furniture, or we have returns and allowances based on those. So all of these have normal credit balances, and in order to close them, we have to debit them. So we debit, and then the total again goes to that new account we just talked about, that income summary general. The biggest one, and I know that it is a lot, but our biggest one is where we have to close all of our income statement accounts that have debit balances. So we start at the top and we have just a few with the income summary and the furniture, and then we have our sales discounts and sales returns and allowances for our departments. And then we have our purchases for the 2 departments. We have our direct expenses for both departments. You can see advertising, payroll, and salary for grills, and then advertising, payroll, and salary for furniture, and then all of those indirect expenses that we talked about that can't go to a specific department. All of those have debit balances, which means that we need to credit them to close them. And so all of those totaled up equal our income summary general debit amount. So then that brings us to our retained earnings, whether we have a net income or a net loss. And that just goes back to where we look here. I'm going to flip backwards. Here is our credit amount for that in our income summary general. And then here is the income summary debit amount for the general. So those 2 numbers are what they're talking about right here. If one of the, and it just happens to be, you can always think of it, you sell more than you spend, you have a net income. If you spend more than you sell, you have a net loss. And in any situation, I always think about retained earnings. Retained earnings, remember, is like our capital account. So if that's going to increase, that means we have a net income. If it has a net loss, that would mean that retained earnings. So back to income summary. In this situation, because we have a net income, gets debited, and then retained earnings is credited, though that of course could switch if you had a net loss. So that's our third closing entry. And then our fourth one always remains the same. It's, oops, oh, I thought there was something to pop up there. Our fourth one remains the same. It's always retained earnings. Again, this information is just coming from our adjusted trial balance. So we just plug that in there. Retained earnings goes down with a debit. And then, of course, we close dividends, which normally has a debit balance. So in order to close it, we need to credit it. And so as said before and done before, we always, after we've done our closing entries, we do a post-closing trial balance. So this is all of our permanent accounts. These are the accounts that were not closed. They continue into the next fiscal period. So we just make sure that our debits equal our credits here before we start our next accounting cycle. And so that brings us to remember the series of accounting activities all the way from recording to reporting is known as our accounting cycle. So of course we check and analyze our transactions. We record those transactions in the journal. We post to either a subsidiary or our general ledger. We do our schedule of accounts payable and accounts receivable. We prepare unadjusted trial balance. Then we journalize our adjusting entries. We post those adjusting entries to our general ledger, which is going to update all of our accounts. Now we have an adjusted trial balance, which means that we can now create all 5 of our financial statements from our adjusted trial balance. We prepare our closing entries, which we just did, and then we post those closing entries so that they're up to date, and that means we can prepare post-closing trial balance. So all said and done, we've now completed another financial statement or a financial cycle for our departmentalized business. You can check that off your list and head on over to our 4-4 Work Together video.